with cost segregation, I recommend that clients do set up a cost segregation study when they acquire a property. And the reason why I recommend that is because you're setting up the fixed asset schedule correctly. We can really catch any errors that may pop up. Maybe the tax advisor they didn't understand the market and they had the wrong land allocation. We can walk them through that in the year that they acquire their property.
Welcome to Streams to Impact, and be inspired to engage passionately in the work of your calling while achieving financial prosperity through multiple streams of high-yield returns on investment to bring your dream of making a meaningful impact to reality. I'm your host, Dr. Allen, and I am delighted that you are joining us today. If you haven't yet, get a complimentary copy of our exclusive guide, High Yield Investment Blueprint. Secure 18% plus returns in 60 days. Go to our website, highyieldblueprint.com. That is www.highyieldblueprint.com. Just provide your email address and we'll send you a copy today. Welcome to Streams to Impact, where we uncover the secrets to build streams of success while living a life of meaningful and purposeful impact. I'm your host, Dr. Allen, and today I am thrilled to introduce a powerhouse in the world of cost segregation and depreciation acceleration. Brian Kiczula has been helping real estate investors navigate the changing real estate market since 2002. He is an active member of the American Society of Cost Segregation Professionals and founder of CostSegRx. Brian has overseen thousands of studies on properties ranging from single-family homes to large senior facilities. Brian specializes in helping investors maximize cash flow through the strategic tax deductions. So Brian, your journey, much like Equus, has been one of the transcending boundaries and inspiring others through your work. So can you share with us the moment or the experience that first sparked your passion and set you on the path to creating streams of impact in your life and the lives of others?
Sure. So I've been active in the real estate market since 2002. Primarily mortgages and real estate was my background. But in 2019, I had a major health, let's just say a major health thing pop up that derailed me. And I literally had to stop working and go on disability for about a full year. And during that time, I had to really scratch my head to figure out how I was going to re-enter, the workforce, the market, to be honest with you. Was I going to get back into real estate mortgages as a full-time career? And, I had some time to think about it. And the answer was no. I did have a background in, reviewing tax returns and certainly real estate. So when I had to, let's say, reinvent myself, I decided to start doing tax returns of all things. I was like, I know what I'll do. I'll do taxes. So I did that for a while and realized that taxes weren't necessarily something I wanted to do full time, because I was trying to, let's say, reset my life and really turn down a lot of the noise that comes with being active in the real estate markets. And then the same thing was with taxes. But what I found at the time was, okay, well, I understand depreciation and real estate, and now I've got a background in taxes, and I stumbled into cost segregation, and I've been just plugging away at it ever since. So it's been an interesting journey.
Interesting, yes. Interesting. I also spent some time as in taxes myself, and didn't find it particularly enjoyable, but but kind of a necessity there.
Definitely.
Well, Brian, tell us, what is cost segregation?
Yeah, so that's the thing, is the why. Why do you do cost segregation? And the reason why that you do cost segregation is to really take advantage of one of the, the 5 aspects of owning real estate. And that's going to be depreciation. And it's really going to be maximizing the depreciation on the assets or the real estate that you're buying. So what I do is I'll go in to a property. Let's say you were to buy a multifamily property or a storage facility. I'll go in and I'll look at the individual assets and I'll reclassify them. So we're not taking the entire acquisition over 27 and a half years or 39 years, but we'll break it down into its individual components, whether it's site improvements, interior improvements, and then the structure of the building itself. So we're doing that to accelerate the depreciation on the property.
So give us a little bit more detail there on really how that works. Do you, I don't know, what do you do? Do you go in and count the number of outlets or the number of light fixtures? How do you do this?
Well, I'm smiling because the answer is yes. I tell my friends and my wife that I count light bulbs for a living, and it's really, it's accurate. I'll go out to a site. I was just up in Nashville last week, and I'm measuring grass. I'm counting the number of trees. I'm measuring the square feet of the driveways. I'm really identifying the exterior and interior assets so that we can allocate them correctly. So yeah, I count light bulbs and outlets.
Okay.
Yeah, so that's exactly what I do.
So, I mean, you just said you're measuring the grass and counting the trees. I wasn't aware those were depreciating assets.
Yeah, so that's exactly right. Is a lot of folks don't realize that, anything that's outside of the footprint of your building, or I shouldn't say everything, but most of the items are going to be reclassified as 15-year property. So if you go in and let's say you're building out an apartment complex and you're putting in, new landscaping, new trees and bushes, if you're to, run the bar test on it, you're making a betterment to that property. And because it's a betterment, you really need to capitalize it. And are you going to capitalize it as a 39-year asset? The answer is no. It'd be a 15-year site improvement. And I think a lot of folks miss that, or what happens is their tax preparers or CPAs will just lump it in as an expense. Mm-hmm. But you have to think about, if you're building, let's say, a hotel and you're putting in hundreds of thousands of dollars in landscaping, then you really need to allocate that properly. Yeah.
Yeah. Well, I mean, I knew any man-made structure was depreciable, but I didn't realize that that landscaping fell under that.
It does. It's not going to be, we're not going to take items that were, so let's say that you have an existing oak tree on the property that came with the land, then, that existing oak tree that's 100 years old, it's going to have to go to the land allocation. Mm. But if it's an improvement that you're making, then certainly. So, and all of the man-made assets as well. So we're talking about the exterior of the building right now. So really what we're talking about is sidewalks, driveways, irrigation, exterior lighting, site poles, signage. The list goes on and on. And really we look to IRS guidance when we're doing cost segregation studies to make sure that we're really allocating these items correctly. And, I just reference, guidelines. That was part of my previous world, reviewing underwriting guidelines. And it's really similar in cost segregation. That's exactly what we're doing.
Okay. Well, what types of properties qualify for cost segregation?
So it has to be an investment property. So any type of an investment property. So real estate. So you have your when you acquire a property, whether it's a car wash or a storage facility or, you name it, we're going to take a look to see what you really bought. So the first thing that you have to do is determine the cost basis. What did you pay for the asset? What did you buy the property for? Then you have to figure out, what is the land allocation? And that's a difficult question to answer a lot of times. There's about 6 different methods that I recommend property owners use to determine the land allocation. And once you carve out that non-depreciable asset, the land, then you can really look at the other assets and start carving them out. And, it's definitely an exciting job, counting light bulbs and working on Excel spreadsheets, because you have to remember it all starts with a spreadsheet. You're rebuilding that property one asset at a time to really give the owner a good sense of what they purchased and assign the accurate, tax life to it.
What about franchises that are renting the property rather than purchasing it? Is there any benefit to them doing cost segregation, and do they even qualify for that?
Yeah. So what you're asking in this case, let me restate, and if I'm wrong, let me know, is you're a property owner and you have a triple net and you've got a tenant in the property that's doing all of the improvements. So in that case, as the property owner, you would not be able to depreciate those assets because the tenant is depreciating. They're doing the tenant improvements. If they're paying for them, really it comes down to who's paying for the assets. If it's the owner of the property is paying for them, then they're going to be their assets in the beginning. But if it's triple net and the tenant's paying for all the improvements, then the tenant would be able to take those costs. Now, what's interesting though is, let's say that there's the tenant vacates and the owner sells, then now the owner owns, the new owner or even the old owner owns all those assets, because they're not taking the fixtures with them. Most lease agreements say that has to stay with the property.
So is it beneficial for a franchisee to cost segregate? They're not the owners, or
they're not the owners of the property or like the actual real estate. They're only the franchisee.
They're tenants within.
Yeah. So what they're going to want to do is talk to their CPA, and they're going to want to look at all of their assets, and they'll do a cost segregation study, but they're not going to include the shell of the building.
Right.
They'll take all of the build outs that they're doing and they're going to depreciate them. And I'm not a CPA, so this entire conversation, if you're listening to it, I would recommend that you talk to your CPA or your tax advisor and look at your individual situation to make sure it makes sense for you.
Yeah. And I'm sure it does vary from entity to entity there.
It gets complicated when you're looking at lease agreements. It also gets more complicated when you're looking at nonprofits. It's a whole different set of rules. So you really have to, dig in and understand what's going on in the property. And I'd say that's one of the challenges that I have, because I work with real estate investors across the country. And I know this may sound, I don't know, it is what it is. But a lot of investors, when they're investing in a lot of assets, they don't always know what they're acquiring. They'll buy, dozens of properties per year, maybe quite a bit more than that. So then for me, it's, really digging through it with their accountant to identify the assets that they've acquired, so we're properly allocating them.
Yeah. I mean, the benefits obviously are the fact that it is just accelerating the depreciation. It's separating items out that can be accelerated. So what are the drawbacks of cost segregation? Why would one not want to do it?
If you were planning on selling the property in the short term, so if you were only holding the asset for a year or two and then you knew you were going to sell it, if you were to do a cost segregation study and then accelerate the depreciation, so you're pulling forward all of the short life assets, the 5, the 7, the 15-year property, and then you sell it, you would get hit with depreciation recapture. So you would not want to do a cost segregation study in that case. So it's really understanding the asset you're acquiring and your your timeline, how long you're planning on owning that property. I would encourage, and again, I'm a cost segregation professional, so I would encourage, all real estate owners to do a cost segregation study. And the reason why is for partial asset disposition. So let's say you acquire a property and year three goes, you own the property and you find out that you've got to replace all the HVAC units. So HVAC units are part of the HVAC system. You have to depreciate them over 27 and a half or 39 years. But if you have to remove those items, dispose of them, a couple of years in, then you can take a partial asset disposition for long life assets. So it's not always, or it's not only about depreciating or accelerating the depreciation on short life assets, but it's being able to take advantage of partial asset dispositions. If you have to replace your roof, or let's say you get hit with a hurricane, or a flood, and you've got to replace those assets. You don't want to have them on your books for 27 and a half years. Right. Dispose of them in the year that you lost them, and then replace them and start depreciating it all over again. And if you have that study, then you have that information.
So whether you actually applied the cost segregation, you have the study in the event of a fire, a hurricane, flood, whatever. Yeah, that's good. Good to know that. So bonus depreciation. Well, first of all, is it going back up to 100% now that Trump is back in office? I haven't heard. Have you?
Well, they try to get bonus depreciation bumped back up to 100% last year. The bill failed in August. It didn't go through. I do think that we're going to see bonus depreciation, if not go back up to 100%, we'll see some changes. The Tax Cuts and Jobs Act really opened up the doors to bonus depreciation back in 2017. So it was 100% bonus depreciation from, September 28th, 2017 through the end of 2022. And every year we're starting to see it phase out. Right. 2023 was at 80%, 2024 is at 60, and it's going to phase all the way out. But with the new administration, I definitely think that we'll see some changes to bonus depreciation. And I think there's a lot of good reasons for bonus depreciation. You've got to go on either side of the fence here, but what you allow investors to do when you allow them to take bonus depreciation is it really allows them to make the investments that they might not otherwise make, because now they know that they'll have that depreciation to help offset taxable income, whether it's active income or passive income, and they're more willing to make improvements to properties. And, I see investors do it all the time. Yeah. If they know they can, get, a large chunk of their investment back, or it'll offset other taxable income, they'll make the improvements to their investment properties, whether it's a car wash or a, single family home. Mm-hmm. So I do think it'll come back, but don't quote me on that.
Yeah. Well, just cost-wise, is there kind of a break-even point on who should even be thinking about cost segregation? If you own one single-family home as an investment property, is it worth the cost of doing a study?
I always tell clients, whether you own one property or you own hundreds of properties, send over your closing statements or your fixed asset schedules. Let me take a look at the individual properties. I'll work up an estimate of benefit, send it back to you, and then you could take it to your tax advisor and then review it with them to make sure it makes sense. So I think getting the estimate, have someone put their eyeballs on the property. So you don't want to use a estimating application. You want someone to, pull up satellite images and, really look at the property, whatever's available online, work up an estimate, and then make that decision, with your tax advisor. So I say, yes, I do studies for clients who own, one single family home. It just depends on their individual tax, scenario. I don't know what it is. I don't know what they're trying to achieve with the study as far as, they're trying to bring down their taxable income so they can, I would just say get an estimate and review it with your tax advisor.
Yeah. Well, Brian, tell us about Cost Seg RX and how is it that you work with clients?
Yeah, so Cost Seg RX, one of the really nice things that I have is I get referred, past clients send me referrals. A lot of CPAs that I've worked with in the past will send me referrals. And it's as simple as literally getting an email or a phone call asking me to work up an estimate of benefit. And that's really the way that, I work with clients. It's nice. Like I said, my past world was, real estate and mortgages, and everybody has a mortgage guy or a real estate agent that they work with. But if you find something really boring to do, count light bulbs, then, you're probably going to be one of a handful of people, in the area that can actually do the studies. And I just tend to get, repeat and referral business from all across the country. And it's really cool seeing different projects, whether it's, a new commercial building that, someone built and they're putting in restaurant and, different mixed use, whatever it is. I get to walk through those projects and, really look at them. So yeah, that's it. So repeat and referral business primarily.
Another question here is, can you do a cost segregation study on a property that was purchased in a prior year, or does this work only for new acquisitions?
Yeah, so with cost segregation, I recommend that clients do set up a cost segregation study when they acquire a property. And the reason why I recommend that is because you're setting up the fixed asset schedule correctly. We can really catch any errors that may pop up as far as, maybe the tax advisor they didn't understand the market and they had the wrong land allocation. We can walk them through that in the year that they acquire their property. Now, a lot of clients are concerned that if they do, if they can do a study on a property they acquired, in 2019 or 2020, the answer is yes, you can definitely do lookback studies. And what we're doing when we're doing a lookback study is the first thing that I'm going to ask for is I'm going to want to see a copy of your fixed asset schedule or depreciation schedule. So I know what the in-service date was on the building. I can see what the building basis was, and I know what the accumulated depreciation, has already been. I know what you've taken. So then when I'm working up the estimate of benefit, I can take that into consideration. One of the concerns clients have when they're looking at doing a look back study is they're concerned that they're going to have to go and amend a prior year's tax return. And you don't have to amend a prior year's tax return. You file, it's called a Form 3115. It's a change of accounting method. And what you're doing is you're pulling forward the missed depreciation using a 481A adjustment. You're just pulling forward that catch-up depreciation. It is important that you work with a tax professional who understands how to complete the form. And you can work with the cost segregation specialist that can, work with your tax preparer to make sure that the form's completed correctly. And so I do look back studies all the time, and it helps out clients tremendously. It really does.
I don't know how many people actually are aware that they can do that. What percentage of your business is look back?
I would say, it's probably split 50-50. I mean, I don't have any number, but I mean, again, it could be the way I, operate too, is I do ask clients if they do have properties that they've acquired in previous years, to send over their fixed asset schedules and I'll review it. And again, it's just a matter of, them setting up that, or having the conversation with their tax advisor to see if it makes sense for them to do it. And then also, for them to understand, it's how much longer do you plan on holding the property? Are you planning on exiting that property? And then if you are you looking at doing a 1031 exchange? So there's a lot of, questions that just have to be answered.
Well, having been in tax prep myself, I would suspect that there are a lot of properties that could benefit from a look-back study, being that, there's not a whole lot of qualifications to be a tax preparer. So,
with that said, though, what I really respect about whether you're a tax preparer, an enrolled agent, or a CPA is just the knowledge they have to have in so many different, it's just so encompassing. So, I literally work on one page of the tax return. It's your fixed asset schedule. That's what I focus on. So I work closely with CPAs that are, they're dealing with insurance and, gains on the sale of stocks and, just there's just so many things. Yeah. So the other big piece, that the client needs to know is, how are you going to use the depreciation that I'm providing? Are you using it to offset either active income or passive income? Because most real estate investors, they're passive. So they don't have an active role in the real estate. And it's crazy when you look at, the way the guidelines are written or, the publications are written. If you own one rental property, even if you self-manage that property, that's still not active income. It's a passive income source. So the depreciation that we provide, or I provide, is passive in nature. It can only offset passive income. So that's why I recommend that clients take the estimates, run it by their tax professional to make sure it makes sense for them to move forward. So they really have, the return on investment for doing it. Most of the time they do. I mean, the answer is yes, almost all of the time. Now, if you're an active real estate professional, you're a real estate professional, which doesn't mean that you're a real estate agent. It just means you're involved in the real property business. Then all of a sudden, it's really powerful because it can help offset active income. Mm-hmm. So that's where it really becomes powerful.
Yeah. Well, Brian, what are your last words of wisdom?
My last words of wisdom. I would say just reach out to me. If you guys have any questions regarding cost segregation, it's like most things. You only care about it when you need to. So it's just in time learning. So just know that if you have questions, feel free to reach out to me. I encourage clients, if they're looking to buy property, they're getting into, real estate investing, and they're going to go shopping for whether it's a single family home or they're going to buy a hotel, give me a call and let's look at it. I can work up an estimate of benefit ahead of time. You can talk to your financial advisor and your CPA prior to making the acquisition. That way, once you do move forward with the purchase, you'll have a pretty good idea of where things are going to land. So my advice or word of wisdom is to really reach out well in advance because, I'm certainly here to help. And I can answer any questions, that you can. And if I can't, I could certainly look for experts and forward you their contact information. And hopefully they can help you out.
So you can get hold of Brian at his website, costsegrx.com. That's cost, C-O-S-T, seg, S-E-G, rx.com. So Brian, thanks for being with us. And enlightened investors, as always, it's been a pleasure having you with us. Please take a moment to like, share, and subscribe. And we'd be really appreciative if you could leave us a rating and a review. So until next time, live abundantly. We'll see you in the next episode.
Thank you.
Thank you for tuning into Streams to Impact, brought to you by Steed Talker Capital. a company empowering passionate professionals like you to develop multiple streams of passive income built on solid passive real estate investments. As a significant part of our endeavors to make a cosmic and meaningful impact for this world, Steed Talker Capital contributes significant portions of our profits to activities and organizations committed to better understanding the equine. These endeavors attempt to enhance the treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures great and small flourish abundantly. If you are ready to learn how our passive investors have earned an average 33% annual return on their investments, schedule your complimentary passive income to Prideful Impact consultation. Obviously, we cannot continue indefinitely to offer these valuable consultations for free, so grab your passive income to Prideful Impact consultation while you still can. Go to steedtalker.com/passive